Welcome everyone. Thanks for watching another video of Markets Are Everywhere. I'm very happy to have Xiaoling Chen and Chef Peters from Kraneshares with me. And for the sake of full transparency, I like everyone to know that I have personally a position in Kraneshares ETFs, primarily the KWEB. I'm not getting paid to do this video. It's more the other way around. I feel lucky that as one of the participants in the fund, I can talk to the people at Kraneshares directly. Yeah, and you can profit from that as well, that we don't have a bilateral phone call, but it's recorded on video also for your benefit to see what is going on. So Xiaoling, Chef, very welcome. Good to have you here again.
Thank you, Jean-Paul, for having us, and good afternoon.
Yeah, and I think the timing is pretty good, and that's what we will see also from the presentation, and I'll get it in with us, that you can talk us through what is going on in China at the moment.
Absolutely, with pleasure. It is a very interesting quarter that, I think ourselves or investors has seen and experienced. I think a lot of you knows our firm, Kraneshares, and then Jean-Paul, thank you for being a very loyal investor with us for this period of time. We appreciated the trust. That's exactly what we like to do with you and many other investors, listening to us today and have been with us very patiently. Like, what we do, bread and butter, is to offer the access to China's onshore capital markets to investors globally. Obviously, Chef and I are here in Europe. Our goal, even more simpler, is to bring the best solution. That we live here, we work here, we know our investor and clients here, to bring that solutions within Kraneshares' whole family to the usage version for the investors to access. We are literally the bridge between the outside of China and China. Hopefully we can provide some market insights to the investors to learn about the market, about the strategy we're trying to discuss. Obviously, we got a lot of requests and asks on KWEB, on KWEB, that's our flagship ETF. If you go to the next page, this is actually all the solutions that we have brought forward to the European land. Today, we're discussing the first strategy under the China thematic equity fund. Obviously, we have 4 equity funds in UCITS world. In US, we have close to 28, 30 funds, but these are the 5 available in the UCITS world. If I may fast forward to the next page. Obviously, we are here to do a timely review of Q1. I know we are early in May, but it's also a good time to reflect what happened in Q1. I remember, last time we chat is in the middle of the year. That's, everything is looking maybe on track to recover. Maybe we see some light at the end of the tunnel. But again, I have to be honest with you, at that time, it's still looking for guidance and reference to really reconfirm that. But if you remember last year, December time, we really feel a huge relief because the vaccine become available, right? And then a lot of the hopes and optimism start to building up from there, to think of at least now we have a way, or potential way, to stop the spreading and potentially manage, contain, and to the phase that we probably will back to the normal of our life prior 2019. So that is really the hope that's built up from the end of the year. I remember in New Year time, that's in the UK, I live in London, that we start to get the vaccine approved. So everyone was really feeling good about it. So I'd say, if I may say, the quarter is an interesting one. It's really, if you look at short-term volatility, you do feel the excitement of the yo-yo kind of feeling. But again, the first half is really like what I said, the optimism builds up, and then people really thinking, you know what, we would see some of the resuming of the factory shops. You start to see France, and also on top of that, US start to add in the stimulus package. They were ready to approve them. The policymakers giving a lot of positive momentum to say we will let the economy back to where they were, or where they should be, the full employment point. So at that point, markets just keep on ready with a lot of I say it's a broad, but obviously with sectors that are giving high, potential for the valuation expansion, really get a lot of benefits from such. What suddenly, I'd say that the second, that you can see on the charts on this page is what we call this quarter is a 2 halves. So you can look at the middle point is right around the Chinese New Year time, and then towards, to be fair, it's mid of February, 16th of February. It's not a magic day, but it's just right in the middle of the quarter. I think when the investors start to realize, and then, most of the hot money or short-term investors like to, price in or forward-looking what they could see an event or potential risks priced in by events. They try to price in those. And in our opinion, it's a couple of things. One is the inflationary pressure. And, sometimes it's, less is more. We all say that, right? But then when the stimulus become a lot, you could think of one way positively saying this will going to support the economy to get out of the, the big deep hole that has been paused for months and years to recover. But then investors start to worry. If that not managed in a nice way, you could have done too much to the market, and then the inflation going to soar through the roofs, and then as a result, bond markets start to react and repress. But then you see the bond yield really picked up somewhere around 25 to 90 basis points just during that short period of time. You could say, in very short period of time with that much of moving, looking at G10 economies, 10-year yields, that's a massive move just within that short period of time with that much. Yep. We get look at, fixed income market very closely. Obviously, we have a Chinese fixed income fund. We monitor the yields. Obviously, they pick up too, but relatively less. That tells you a couple of things. Investors is worrying about inflation. They are doing rotation out. The long duration interest rate sensitive assets in the equity world equivalent get smashed. So those stocks really didn't have a nice second quarter, and then a second half of the quarter, namely KWEB itself, right? The first quarter really 25+% return, and then the second half of the quarter start to get the huge pull down and pull back.
Would you say, if I can ask, is this something that goes hand in hand with the same market move in the US? China and the US here are comparable, or are there different things to the Chinese market?
That's a great question. I mean, the pullback can be explained by the yield move, and then some of the hot money of saying I take some profits odds, right? A good catalyst to do that. And additionally, there's also a much bigger scale of pullback if you compare to with the rest of the world. But for the reasons of, I would call or classify them more of a headline news. For instance, we have on this page, the HFCAI. So that's more of a regulation continuously managing for delisting, foreign listing, potentially more names, all these concerns. I'm not going to go details on all of that. The reason for that is in all the client meeting, every possible chef is here. Many of you know chef, you meet chef personally. It's hard to not look at short term when you are in some kind of equities that are relatively high in volatility compared to US, compared to a developed market. You got yourself into the move of volatility, your mood get traveled with that volatility. But we tend to tell clients, listen, what we encourage you to invest, for instance, in KWEB is the consumer power. That power is decades and generations. It's not going to disappear, and the catalyst will run out of the momentum in a quarter, in a year. We really think this is, though we call them a thematic approach to China, this is really the long-term core holdings you should hold in your China portfolio. I make it short. So the volatility happened during that period of time because of the headline news. This does not fundamentally, you got to ask yourself, did this change my view fundamentally on this company? Is this company producing what they're supposed to produce? I am paying the value to buy their growth. Do they producing that growth, right? And in our opinion, none of that says no or alarming of risk, saying be very cautious and careful. None of them are saying that. And if you could help me to go to the next page, Jean-Paul, this is
But perhaps you have on the previous slide, we'll come here, on the previous slide, you also have regulation. Yeah, and if you look at the top holdings, obviously, I think a lot of people see that China will be getting there longer term. At the same time, they see all these headlines about Jack Ma disappearing and what's happening to Alibaba. I don't know, actually, is it known what he's doing today? Is he working hard, or and also if I look at the headlines, say, well, Alibaba has only been a first. And now perhaps Tencent, Meituan, Pinduoduo, they'll get similar punishments like Alibaba. So people really want the Chinese internet stocks to do well. They know they will do over time well, but is now the time already there to say the worst is over with respect to regulation?
That's a great question. That's a very tough, challenge question, but I say it's in a lot of investors' mind. Each company had some sort of change in personnel, I'd say, in one way or the other, but they all because of different scenario. It just happened in the recent month, if not the 2 quarters in between. But I say each of them have a different reasons of that happened. Yeah. I want to help investors to think of them differently, separately. It's just timing is now. Jack Ma and Financial supposed to do the largest IPO in history, right? Everyone eyes on it, really is going to happen. We get excited because that's really a good opportunity. Obviously, regulation came in and say, you know what, we really want to look carefully to see. It was just a coincidence of the time when the fintech regulations comes in at that period of time, right a few weeks before they're going to go public. They're not going to announce the regulation because you're going to go public and they hold it back, or they do it quicker or sooner. So the regulation came out and they say, you know what, we got to see how you would assess against the new regulation. Obviously, the timing is not perfect. A lot of investors say they could have managed that. I think they did the right thing. I don't speak for them, but from an investor perspective, I want to invest in, because you know our approach, we never buy 1 or 2 or a single stock. We recommend client to hold a basket approach for a very valid reason, because Jean-Paul, we want to take advantage of all the winners. We don't want to manipulate. We don't want one big winners, right? We don't want to say, hey, they are dominant, let's just invest in them. Obviously, and financials is one of them, agree. But then we don't think that's the right way to approach. So let me tell you, so Ant Financials, they're going to seriously think of themselves. Are you a technology? Are you a financial? And are you going to allow other players to come in and play? But that's only for long term of the investors' benefits rather than the company's benefits. So I think the regulation, obviously you could argue the timing, but I think the change of Ant got to look their each individual line of business and then thinking of where they need to classify them separately. This is a financial, this is what you are doing in going public. I think long-term, it would be good for investor. In terms of Jack Ma, he's always a very outspoken person. He likes to speak of what he thinks and he believes. And I think rightly or wrongly, he has his opinion, just like ours. He criticized the system and everything like that. He's quite advanced thinking. If you think about Alibaba, when they set up Alibaba in those years, it's a challenge and revolution to China's commerce market, doing everything online, e-commerce. Obviously, he's in an advanced stage. I don't think it's because what he said, and then that's what happened to Ant. It was more of timing couldn't be, it could be managed better, but it just happened coincidentally during that period of time. He's still running a lot of the underneath core thought or thinking of how Alibaba going to direct their business or strategy in the next generation. I don't think he's going. And then I think you touch base on a few. Obviously, Pinduoduo also get some change, right? Their CEO.
They have the CEO is also stepping down, right?
Right. So when they go IPO in US, it was a regulation to say within a year, the first year you are exempt from having the board of directors are also executive at the firm. That's totally fine. Within the first year, you are exempt from it. I think majority of the board directors are not independent. they are running or they are holding a position at firm. So they could be the chief auditor or chief accounting, chief CTO, technology officer. So they're holding a position at the firm, and they also are the board of directors. So a year up, they listed in US. They did a bit of a follow this standard and procedure. They have to do it. So within the year they planned. So they have removed quite a few board member, including the founder of Pinduoduo. So he then get out of the board and then put in 3 new independent directors. Okay. In that sense, is that good for investors? Yes. In my opinion, will I be welcoming that change? Yes, I completely welcoming that change, because the founder itself, I think he hold somewhere around before listing IPO, he hold 50+%. He has the majority, and he has a super vote kind of mechanism, 1 to 10, yep. Literally owning 89 to 90% of voting right of Pinduoduo himself, right? And then by him let go of the board of directors and then subsequently CEO, he then let go of that super right. His equity become around 40+% now. The rest is majority owned by the market and then some shareholders, etc., etc. Is that a good thing? Who is the new CEO? The new CEO is Chen Lei. What his background? They are buddies at university, so they know each other. They work with each other since 2007, about 14 years ago. They are schoolmates. Okay. They set up the business almost together. He used to serve as a CTO, so Chief Technology Officer at Pinduoduo. His background is AI technology. I think it's a good successor. They plan for it clearly. He's knowing what Pinduoduo want to achieve. Most importantly, Pinduoduo need to work on their infrastructure, technology, logisticals. Why? Because you really distributing. I think Pinduoduo literally had over 1/3 of the parcels that flying around in China is bought and sold on Pinduoduo. So you can think of their logistic technology, AI, coordinating those are so important. Yep. And I think they're going to have the expertise to make that even better.
Very good, very good. Excellent. It sounds comforting. Shall we go back to what we see here?
So I'll make it short. I think what we're trying to say to an investor is the regulation, the headlines on delisting, listing will be there for a while until it settles. But then from an investor's perspective, what you worried is, will my stock get impacted? Will I get charged on fee? How is my investing continue to be the case? Here we show you 2 pie charts showing some of the stocks are saying, if I get delisted in US, I'll go back to Hong Kong. Some are already started listing in Hong Kong. So we did a similar study saying, if the worst case come to worst, can we switch the shares without any issues, impact, fee whatsoever on clients? The answer is yes. So what we did here is seamless transfer within a day. We could switch our portfolios from what we hold currently in Hong Kong, 30+% to 70 without an issue. Clients that didn't feel impact and doesn't have any impact on their portfolios, on their cost whatsoever. So that's really what investors should keep in mind. There's regulation headline news. Will that impact me? The answer is almost nothing to know. If you go to the next sector, what we want to
so here this on the right hand side you say a hypothetical conversion. Is it so you will just with KWEB follow the index, right? So if the index provider changes to the Hong Kong listing, then the KWEB will also change.
Yes.
Is that correct?
That's correct. So, but what happened is we say, because a lot of the other indexes are starting to do that because they say, we have it here on FTSE. They already started doing that, saying, the same name listed on both exchange, same company. I go to the less volatile market, so I start to include those in Hong Kong. FTSE already did it. We do think, MSCI is likely also to follow this suit, to also implementing a local or a different share class locally listed for the same company. So clearly KWEB has a name that listed in US or listed in Hong Kong. So if we say worst case come to worst, how quickly and how soon, how much do we need to move that to Hong Kong? That will be the 70%. And then how quickly we can do that? We can do a switch like that. We already did some of the switches when some of the news happened. we really want to see in the real world what is the process, what's the investor's impact. As a result, we can confidently say that after our seeing implemented, this is not hypothetical, there's no impact to clients whatsoever.
Okay.
So obviously, KWEB is very well known to your group of investors. The holdings in its fund is really the whole ecosystems of the the e-commerce, online education, everything you can think of in a very innovative, modern, lifestyle that you would need the services along. You order food online, you do education online, you buy your groceries online, you do your clothes shopping online, all those things with no problem. So here obviously we break KWEB by subsectors to show how each are performed. I think this is not come as a surprise. As you can see, the performance is reflective of the sectors, I would say, recovery from the pandemic hit. As you can see, some of the real estates and travels had most of the challenges, let's say, in terms of performance. But then that being said, what we want to draw investors' attention to is, given everything slowly resuming, and China, don't forget, they are a year and a half almost ahead of the full recoveries that we are experiencing now. So we do expect, particularly right now, it's the Golden Labor Week of national holiday. You have here a lot of pickups in spendings and revenues in those travel names and then tourist names. So we do expect those companies will have a good earning report in the next quarter to follow. Yeah. Those
I like these graphs a lot, and actually for me it was a little bit of surprise, but I always like to see these kind of breakdowns. But if we can just shortly pick out the two extremes on the left hand side, you have fintech is doing very well. Is that because the Ant Group listing didn't go through and now other companies have more room to maneuver? And perhaps on the other side, education, I'm surprised because these edu-tech firms in China seem to have such a good proposition, but apparently they haven't done really well. Is there a specific reason for that in the first quarter?
I think the fintech broad market outperformance, Jean-Paul, is, in my opinion, is thanks to the good anti-monopoly or more regulatory, more transparency introduced to the market. So the market is broadly welcoming such initiatives. So investors are awarding or rewarding the companies that can be more players come in, be more fair. So that's a good story. On the education, I have to say, Tao as a online top, education companies, they have very strong infrastructures. So when the pandemic hit, what they could do is they quickly expand their technology and infrastructure to lower tiers of the city, tier 2, tier 3. So in the past, they have online, they also have offline, means they have a office place, people go there, Post-education tutorial is crazy. When I was a kid, the summer break is never a break. You go to tutorial, like my mom booked me my time up. If I go to school, is in normal time is 8 to 5, I finish. And then in the summertime, my mom started to book me into the tutorial from 8 until 6. It's even worse than if I go to school. It's just like it's crazy. You wish you don't want summer break because it's not a break. It's not nice. But then you go to the schools, you go sit there, you do this whole day education again. But this education, some of the players are a bit of struggling. Why? Because they can't quickly expand their technology. They can't quickly, make their offline courses to online quick enough. They don't have the budget finance, so they did suffer losing the market shares to the big players that they can do quickly. Some of the smaller shops are going to lower tier cities, and they handhold, let your kids come in and do face-to-face with your teacher. That's also a favorable model. But now, because of the pandemic, they're not coming in. They can't come in. So as a result, very sharply and quickly for those education centers are experiencing a shortfall of revenue and returns. So as a result, I think this is a huge dispersion within this subsector between players.
But it's also, again, you know, good to diversify in an index, right? It's
yes, and then the in face-to-face education is still the favorable way. Teachers are still preferred, or families or parents are still preferred, that you have a teacher one-to-one or one teacher with 2 kids, very small classes, very focused and dedicated effort. So those still will be the favorite way to do post class or after school tutorial in China. So you do expect those players get hitting down, you know, because the pandemic will pick up in revenue in the coming quarters when these become more settled. And then the online ones would just getting more market shares in the lower tier city, even the reach of the countryside of that. So here we showed you some of the top holdings within the firm. Obviously, we firmly believe, you know, the rally that we see last year. A lot of people say, hey, the rally was quite a significant one of last year. Do you think this can continue? We completely agree. I think last year is really built up on a valuation expansion. People are hoping and seeing, you know, China will out first. You got to see the results and et cetera, et cetera. We do see the valuation part, you know, pull back a bit to more of the normal level, I'd say. But then the next phase that the equity market today is in is to say, can you deliver the growth that you're supposed to deliver? So in the growth phase, from the hope to growth, what will happen is the earnings and the growth will mean a lot more in the coming quarters. Obviously, the Chinese companies are still, you know, reporting their first quarter earnings this month, and last month they're still doing it this month. Out of the 60+% of the company reported that first quarter earnings, we have seen almost 58% of year-over-year growth. So that's very encouraging to see. Obviously, we list the companies that we see here. I know there's a lot of numbers on this page, but what we're really pointing out for you to see is really, you can see the 2020, the earnings, and then into the 2021, there's very high growth potentials that we see in all these companies to happen. But that being said, if you go to the next page, you will see.
Whose estimates are these? Is it Kraneshares or is this another firm?
I think this is where we got it from Bloomberg, and then I think this is the data that we literally sourced from. I think we have
CICC.
CICC supported ours too. We also have used, I believe, some of the FactSet forward.
Okay. So it's not Kraneshares; it's a third party.
This is more of a market estimations.
Exactly.
That we consolidate in one page that is representing holdings of our fund. Obviously, if you look at the fund level, you would see, you know, a lot of people argue the tech or kind of the e-commerce companies are at high valuation. You know, we do agree 20 plus, it does look at the high end, but if their earnings pick up, match that, you are paying for what you will get. And then
exactly.
Look at the long term, it's really not really at the alarming level. Literally, it's going back to the median level. What we also want to compare and show investors is really on the next page is relative story, right? And then see where we are in terms of the Chinese tech compared to its peers. You know, we always want to think, because to be fair, each of the individual players, they are the leaders in their own industries, but then some of them are actually leaders in doing what they do. Remember, you know, Alibaba, Taobao, and then, you know, Pinduoduo and JD, they sell everything online. We keep on saying, remember, even before the pandemic, everyone is buying things online, the grocery get delivered to your doorstep. You feel less relevant to your own or compared to your own lifestyle until pandemic happened. Everything seems fast forward to those business models now get implemented to our daily life. So that get a sense that, you know, it is the trend that, you know, globally is evolving to. So we did a bit of a comparison saying, is where China tech is today, how does that look compared to United States? For instance, are they overvalued? Are they too expensive compared to its peers? Clearly on this page, it just shows, you know, the Chinese technology company obviously still offer a huge gap and discounts when you compare to US. There's a room for these companies to grow. You know, the gap obviously will be arisen there because they're still developing, but what we also say is a lot of names in KWEB today are also leaders in their own sectors and subsectors, not say behind the US peers. So they should be in the comparisons that we would see that they should catch up the gap with US, trending in line with US in the long term. And then, you know, on the next page, Jean-Paul, we often get asked, you know, by clients, you know, with volatility. We mentioned this at the beginning that in Asia, in EM, in China particularly, volatility is never short. In these kind of markets, you always see volatilities. We often get asked, you know, when it's a good year, did I miss the boat? You know, and then when the bad year is, am I catching the falling knife? It's all very fair concerns, right? We ask that about, you know, ourselves on those markets. So, you know, we tend to, and we always try to help the client to think a bit of a long term. If you invest in these funds for the longer period enough, you would have, you know, obviously right through the volatility, you hold tight to this return, but you would return 100+% from it. But then if this year, if we could have a look, you know, the kind of volatility we see on this page, you will see the 20+% pullback. It does feel like probably in the 2015 or in the 2020, right? And 2015, yep. Remember, it was the global market is concerned with China slowing down, and then the interest rates in US. When will that go into raise? You know, towards the end of the year, it happened. But then you remember the growth stocks, you know, in 2015 with those kind of background noise or information, you could call them, it still returned positively 20+% that year. Obviously, this kind of 20+ volatility pullback, you could also compare to 2020, but then 2020's market sentiments of, or if we could call them a bear market sentiments in 2020, is more of a event driven, right? It's very unprecedented. It's never happened. It's triggered by this global pandemic, where today is also very different. But 2020, with the similar scale of volatility pullback, you still see 70% in 2020. You know, and then obviously we ask ourselves, you know, clients worry about inflation, worry about bond, worry about the growth, worry about these. Are these warrants? And then is the bond yield telling us something, or the bond yields itself is normalizing? You know, you could, you remember the bond yield is almost also a, you know, the other way of a V shape. You know, at beginning of 2019, 2020, it started to press in very deep and prolonged recession. You know, the yield was at all-time lows. You know, in our opinion, this is Kraneshares' opinion, is this yields pick up. Obviously, it's not a friend to the growthier stocks, but it's really just normalizing of the potential growth that the market is trying to press in. So in this instance, we do encourage investors don't get, you know, distracted by near-term, short-term volatilities. You know, and right through the whole thesis, we ask ourselves if this is changing our view of the thesis. We don't think that is the case. So we don't encourage investors to do that too.
Yeah, and not too much hop in and out and then miss the peaks. And exactly as you said in the beginning, just to have it clear, we have two charts here. So on the left hand side, it's let's say the KWEB index, and on the right hand side is the MSCI China A shares. So that belongs to the KBA, right?
That belongs to KBA. So what we have is a
so it's two charts for two indices.
Correct. Two charts for two indices. Story stays the same. KBA even stronger. This kind of volatility is not a huge pullback compared to the similar years. They really, you know, warrants stay hold with your investments. Here we show you in terms of performance. Obviously, it's not a future guidance, but again, it just shows you, you know, in the long term, investors, you benefit from holding it tight to the investments. Your returns rewards you with this kind of volatility you hold in your investments. And Jean-Paul, if I could change gears slightly to think of this quarter. Obviously, we've gone through the valuation, what we see as a momentum, we see the volatility, we see long-term returns. And the one thing I want to mention to the investors of your group is the very important event happened in China in first quarter. Is this national, if you go to the next page, is the
yeah, right.
Yes, it's the China's National People's Congress. It's NPC, people short them. In each of the NPCs, they set a 5-year plan for the country. What is so important about this 5-year is it mentions industry sectors that's going to be focused to develop or enhance or advance for the next 5 years. John and I both have some friends, John Crane, our CEO in China. Some of our friends in China literally changed their careers, you know, because of this 5-year plan to the industry. Yeah, John's friend was like, "Hey, John, I changed my career to da. He's not doing green vehicles, automobile in China." And it was like, "I changed my career because that's what we'll be doing for next 5 years."
Wow.
The people are reactive to that, but the reason for that, Jean-Paul, is you got to think about it's a developing country in China. What they're trying to do is to make the whole country move in the direction that eventually make them a modern or developed market or modern society. And then when they have a 5-year plan, they got to do the subsequent support to those industries. They give you favorable terms in terms of tax. They give you favorable terms in terms of financing, borrowing for your sectors. And then a lot of industries are adopting or changing their gears to achieve that target quickly. Because of this policy, they can help that business to advance. And in these 5 years plans, a lot of things get mentioned in these 5 years plans. Obviously, you know, what worth mentioning is the heavy mentioning of the technology developments. And obviously, they say they're going to encourage firms to do really the core, very important breakthroughs. The reasons for that, as you know, we all know, China is focusing on their own domestic capabilities in achieving, like, really in the major developments for them to become, a leaders in some of the core technology areas, right? To make themselves self-sufficient, to hedge against the uncertainties in the global environment. As you can imagine, what happened over the last few years and where they are today and where they wanted to be in the future. So that's very, very understandable. So technology get mentioned a lot and heavily on this page. You can go through the notes, but then I want to also summarize some of the other areas. For instance, the promotion of the domestic demand. Really, this is focused on, one, improving the quality of the domestic supply. So you got to really to the next stage of the quality supply chain side through very much of industrialization, also by, to satisfy or by increase the demand for quality by the consumer. So that's very understandable. And this focus, obviously, for instance, some of the manufacturings are looking at upgrading their sectors, and then some of the sectors are looking at going to benefit and from the increasing urban and rural kind of mobilities in all these areas. So all that being said, this 5-year plan, really, you can tell a lot of these focus are really going to continue to expand and everything like that. But you can get a sense the focus will continue to benefit for the names that are holding KWEB, right? The e-commerce, the domestic play, even the green side. We have, some of the, green kind of companies also in this fund, and we also have in other funds. So it just shows, if I may summarize the 5-year plan, I just pause here and summarize the 5-year plan is, many, every 5 years they have the plan. If you think of the old history, obviously they try to rebalance from the industry to service sector. And then since then, from 2013, every year they have the 5-year plan. It's more focusing on, let's expand this, let's make them solid fundamentally. I think what difference from this 5-year plan to the previous one is, this is telling the industries and sectors in China, you all going to advance what you do. Keep on just massively growing, but you're going to advance what you do. You're going to make yourself a leader in each of the sectors, in technology, in green, in carbon. You got to achieve the 2060 neutral kind of goal. So I would say this area is advancing the entire China society to become a very modernized society in that way. So that being said, names in the KWEB funds is going to benefit from them either by financial e-commerce online holding. Also, we have online healthcare. Remember, those are also the subsectors holding KWEB, and that's the area China is focused on reforming the healthcare services, allowing the services to reach the very rural, the lower tier city in China. Those names in KWEB definitely going to benefit from such. And then a lot of the names hold in KWEB, we repeatedly said, they don't hold one line of business. They almost across, they hold the whole ecosystems slightly differently in a very healthy competition way, but they can benefit across. We have some of the names under each of the categories, but I think it's not strictly black and white of you are just in this bucket or you are not in that bucket.
Right.
We represent some of the typical names that are well known in each of the bucket, but they are not just restricted to that bucket in that sense. I just in cautious of time, if I may ask you to go to the next page.
Yeah, sure.
You would realize this page, and then many of your viewers will see this page. It's always in our deck, and we always use this. It's really a way that we track, and how these, China's internet sectors or e-commerce sectors has been doing. It's our checklist. Are you progressing? Are you, doing the delivering what you're supposed to deliver with the expectation here? And obviously, on this page, we showed, how many people in China still have internet, and then hence that still not have the internet, right? And the number used to be around 800 plus million people. Now it's over 900. Just shows significant growing over the years, over the period. And obviously, one numbers I point out in the other webinar, I like to say that here again is the retail sales. I remember when we first put this table together, China is way below, probably half of where US is. And then just over a short period of time, KWEB is only 7-8 years old. Obviously, when during this period of time, China not only meet with where US is, exceeded where US is. Look at, they are $2 trillion ahead of United States today. Just shows that kind of power. By investing into this fund, you are benefiting from that power of growth in this sector. And then the following page is the top 10 holdings on this page of the KWEB's names. We're very familiar with these names, in our fund, and obviously, I think this year, though we highlighted the earnings growth on these names, but what I think is very interesting to watch for these names, and then they got to deliver and prove, is earnings again. But when that earnings, how that earnings can be achieved by multiple ways. But then one thing is very important for all these companies on this page to have a similarity initiative is 2021 will be a huge year, massive year for investments for all these years, and then for all these players to achieve the growth that they are aiming and hoping to achieve. Alibaba also pledged they're going to do the largest capex in 2021 into 2022. They're also going to focus some of the, in their own business revenue, less developed areas like the Taobao deals or the live streaming, the potential of the TikTok, the equivalent in China. And Pinduoduo, we mentioned Pinduoduo. I like to mention Pinduoduo. It's an interesting concept. They raised some of the monies, I think over $6 billion just last few months in 2020. They are going to use those money for investing in logistics. We mentioned that, logistic infrastructures. And the one thing to mention is also the agriculture food chain. They really want to bring those very much the food from the farmers itself to the consumer. So it's a big initiative. It's going to be supported by the government to like that initiative. They're going to invest a lot on logistics for sure, and also in a bit of a consumer to get with the manufacturing or the producer directly. And also JD, we know JD. Jingdong also had a very good good year, but they also expected to step into or pick their line of business revenue, for instance, in the lower tier cities of a supermarket. So they're going to do that initiative as well. They're going to continue to invest. They are still one of the, they are the three largest, Ali and Pinduoduo and JD are the three dominant players of all the parcels flying in China, billions of them. These three are splitting them. So JD also going to invest a lot on lower tiers logistics and also supermarkets, because they literally don't have that part like the other people's other players does. So you can tell the investment is going to be heavy, supporting their whole line of development, and the whole ecosystem going to become more diversified. Investors will have, or clients, consumers will have more choices to choose from, each of the platforms to use. So that's definitely going to be a beneficial for clients to consider of diversified availabilities.
And if I can add a short personal note, that's on my own account of it, but I like both stories. I like the China internet story, but I also like the US internet story. And it's just because of what you show here. It's the double-digit growth that you see. And I think a lot of people still see these kind of companies as growth stocks. But for people who are more familiar with the US names like Amazon, I think Amazon is here twice, but perhaps that should also be Apple in that. Oh no, that's a comparison with the one on the right. Anyway, if you look at Amazon, Apple, these stocks are almost becoming value stocks because they produce such a lot of cash, but it's value stocks with still a lot of growth. And to my personal opinion, I think you also see that with the Alibabas, Tencent, you know, they generate so much cash. It's not a typical growth stock that you need to worry whether they will exist in a couple of years from here, right? It's
exactly.
It has a solid foundation.
Yeah, like when they're going to have the cash, right?
Yeah.
So on this page, I think is the whole fund, characters of the fund, the strategy. We leave it here for you and investors to take them away as a cheat sheets to understand the strategy of the fund. The next page, we really have some of the our summaries, if we may say, is a lot of obviously continue to watch on the market. If you ask me, the key support and catalyst for us to hold and then being very optimistic is the policy issued by the government, the subsequent support financials or in any ways of supporting these developments will come out also quicker in supporting all these sectors on this page in the middle of the box. Obviously, we hope the talk between US and China, the tension between US and China, the two big in China they have a say is if is a wife and husband situation, they fight, but then at the end of the day they have to get along. They have to get along. They're two largest economy. They need each other in many ways. You're manufacturing and advancing. So in a ways, now I think it's more constructively coming back to the table and talk more constructively on what various issues, how we're going to solve them, how we're going to target them, how we should work more constructively. I think those are all on the good ways of trajectories to be dealt with. Obviously, if you ask me, the risk is what if this doesn't go right? But I do think both party in charge right now would have the right intention and experience and way and also the willingness between both sides are sit down to talk and work this out. Rather than creating headline volatilities for both. So that will serve as a positive. Obviously, we continue to watch if we have healthy pipelines for investors to continue to benefit from seeing new players come in. We mentioned Didi. This is the dominant player in China. It's the only player in China in the share car services. They basically moved Uber out of China because they're out of business. They're very convenient. I use them all the time. You literally pay very cheap. It's like unbelievable low rates and good services in China. So they do have a reason why they can be dominant player in China. I remember when I go back to China and take my son to travel, he's very young, and the driver was very nice and taking us, and then from one place to another, it's just very good services, and altogether I paid like a 10 renminbi, that's like a pound and a half. Wow. Journey. And then I was like, it's some distance. It's not like, oh, it's from door to door. It's some drive. And then at the end of the day, I check my bill. It's like 10 renminbi. And with the service I get, I was like, oh my God, I can't believe this. So good services, very reasonable price, continue to get market shares, and they are building up to lower tier cities in China as well. It's very important those continue to grab the market shares, make them available in other cities. That only will support them to become very welcomed player in the IPO market. And then obviously WeDoctor is another thing to watch. We are very promising to think Ant Group will come back even stronger and solid. Would be a very transparent model for investors to understand and potential investments opportunity to get into KWEB fund for sure. And we also have events coming up on the next page. We would love to invite your audience to join us if they can. Here we have the address for your investors to register and join us and listen to us. We get really good speakers to speak with us. This is our mid-year institutional investors day events. So if you can join with us.
But this will excite a lot of people personally as well, because you may not know that, but almost every individual investing in China in the Netherlands has NIO stock. Yeah. So I think to have the opportunity to be in a webinar with the CFO from NIO, that will attract a lot of because everyone wonders, with this new factory that they're going to build and problems that Tesla may face. So there's a lot of excitement about the stock, and I think it's quite unique that you have the CFO from the company with you.
We are very excited to have Stephen. We interviewed him for an article. He's a very, very sound and solid guy, very good vision. I think he's going to share a lot of good insights, not only on NIO, also the industry, how you would see the opportunity arise in, for NIO and also for the industry. I think it will be a great insights for the investors to delve in and join us and listen. Obviously, we're going to have the ambassador talk. We have a ex Singapore ambassador from US joined our firm not long ago, David Edmond. He's going to interview Max. So we're going to have a ambassador talk. So I think we're going to have quite a good speaker lined up for investors to listen from various topics that is all in top of the client's mind.
And this is really open for everyone who wants to join, because it's now public, right? If it's in this video.
It is public in this video. We want to make it available for your group.
Excellent.
Sure.
Excellent.
Chef, would you have any?
No, what I'd like to do is obviously, Charlene, thanks as always for sharing your insights. I think it'd be good just to highlight that attendees can see my email address here.
Yeah.
What Jean-Paul highlighted in the beginning is that KWEB, our largest and flagship ETF, is registered and available on most of the platforms that your investors will use, including Bing Bank and the Hero and Saxo Bank, etc., ABN AMRO, ING. But if investors have any issues, accessing our funds, please contact me so I can help. All of the funds that we have available, all of our UCITS funds that you saw on the first few pages of the presentations, are registered in the Netherlands with the AFM and have a Dutch language key investor document. And if needed, we'd be happy to provide that. And I think that also, the research that we have available, we publish a quarterly China Internet update that I think will be of interest to investors in KWEB who want to learn more, about the different subsectors, the performance. We obviously highlight the 10 largest funds, and I think what was visible in the page about the 5-year plan is that one of the areas of focus for China is healthcare, the development and the availability of healthcare. And while obviously a number of the KWEB names have exposure to that sector, we also have a specific healthcare ETF. Ticker is CURE, K-U-R-E, which is the MSCI All China Healthcare Index. And then again, if, in all honesty, if clients, feel that KWEB, is a little bit too volatile for them, they can get access to the names in the KWEB index, but also to A shares and some of the other Hong Kong names through our KESG ETF, which is the MSCI ESG Leaders, MSCI China ESG Leaders ETF, which is exposure to New York, Hong Kong, as well as local A shares listed funds. So that's very well diversified. It's performed very, very strongly, and it has a very strong ESG filter that we know a lot of investors are looking for at the moment.
Okay, well, thank you very much. And I think for the people watching this video who don't know Chef yet, he's been silent while Xiaoling was talking. But when you have him over, you know, then you get even more China stories. I think it's great to have such a representative for Kraneshares present here in the Netherlands, you know, to share even more insights on China. I would like to thank you both a lot for doing this. I think it's extremely insightful, and I already look forward to a next occasion. Thanks a lot.
Thank you so much. Pleasure to be here. Thank you.
Appreciate it. And do join us on ChinaLastNight.com.